Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. A very busy week. We've had almost a complete reversal in fixed income this week from where we were last week. But looking ahead, we've got an even busier week probably next week with the Fed and the Bank of England up. So let's start with the Fed and Jan with you. I guess to start with then, can you just give us an overview really of what we're expecting from the Fed next week? It's obviously being pitched as quite an important meeting, I think.
Absolutely. And I think we started touching upon this over the past few episodes too, but generally our expectations haven't really changed in what we should expect from a high level picture on what we're going to get next week. That is a 50 basis point hike, higher than the 25 basis point kickoff at the last March meeting, and an announcement of quantitative tightening announced in May, and then which starts in June. We envision a program that scales up to its maximum limit in 3 months. And the previous meetings minutes were sort of clear about that. We should expect 60 billion cap in treasuries, 35 in mortgage-backed securities. And in our view, we think that the Fed is going to run this program until, for our base case for now, is at the end of 2025. We'll see, which kind of brings the total balance sheet reduction down to like $3 trillion. And after that, we would think that the Fed would try to take a trial and error approach, see if the reduction in reserves is okay with the banking system, should they, stop at some point or go faster, and so on. And additionally, again, by the time this episode is out, we probably will know, but we're going to get the employment cost index at the end of this week, which should be kind of like the last important data point going to the Fed meeting. And as a reminder, that is the Fed's preferred inflation gauge for wages. So if that number comes below expectations, which are centered around like 1.1% in the quarter now, if it comes below that, or like let's call it half that, I think that would give a lot of ammunition for Powell to go out in a press conference and basically eliminate any lingering doubts about hikes larger than 50 basis points. On the other hand, if we see a print that comes at like well above consensus, and we keep seeing these inflationary pressures in wages, then that opens the room for kind of market pricing in a little bit more. So far, we maintain 50 basis points for the next meeting and 2 more 50 basis point hikes at the subsequent 2 meetings. After that, they revert back to 25 basis points in our central scenario.
And how does that fit, I suppose, versus where you think market consensus is, or which ways do you see the risks as being skewed, I suppose, from next week's meeting? Do you think, if Powell is to surprise, it's more likely to be on the hawkish side, or would he opt to be more on the dovish, more cautious side?
So I think I'm going to take a little bit of a turn compared to the last meeting, where we did expect a hawkish surprise from the Fed, given the kind of lack of pricing going to the meeting. I think at this point, we have reached almost perfect pricing for the data that we have behind us. Of course, a lot of things can change in the coming months from the inflation standpoint, but I think the market has done a very good job of pricing in exactly what the Fed communicated. We kind of managed to stray away from going too much to either side. And as Powell said it earlier last week at the IMF panel, that markets have taken our message very well, baked it in the curve, and he's happy. And we've been having a lot of discussions on why the Fed doesn't do something like 100 basis points and kind of go way faster than what it is now. And just shortly on that, our view has been that, well, the Fed is in a good spot because the terminal rate pricing is slightly over 3%, and the forward expectations are already doing a lot of tightening that they have in mind. The mortgage rates are above 5%. Anyone who funds themselves in sort of like project financing or asset-backed lending, they're already using the forward pricing as the kind of like their benchmark. Only the kind of like interbank, very overnight lending that happens that's based on the spot rate. So the Fed shouldn't go, in our view, much faster than what's priced in right now, given the economic backdrop. So they don't kind of even remove some of those forward expectations, don't increase the odds of a hard landing, which would lead to markets kind of flattening the curves. I don't think that's what the Fed wants at this point. So in our view, markets are priced in the right point. And with that in mind, last week we kind of suggested scaling into long positions in the 10-year, as we discussed in the last episode.
And as well as the Fed next week, we also get the quarterly refunding announcement. So what are your expectations for that?
So that happens to be on the same day as the Fed meeting on Wednesday, but it comes before. So in our expectation is for the last round of coupon cut announcements from the Treasury, albeit at a smaller size, only $1 billion across all lines and 3 in the 20s, which have been this perennial underperformance since inception. And after that, the Treasury will probably take a halt, reevaluate where they are, and with the start of QT, funding in private markets the needs for funding in private markets is gonna go up. At this stage, it's important to keep in mind that Treasury is well overfunded with the current rate of issuance. April tax revenues were extremely strong, well above any forecast that I have seen, including ours, which means deficits are going to come a lot lower than previously penciled in, possibly below 800 billion for the year. So we've done the Treasury has done a lot of progress on that side, and that will take kind of like the immediate funding needs. If anything, it will give them a lot of runway to run down its cash balance, which means more bill pay downs and perhaps even larger cuts in coupons. We don't expect that, but they're in a really good position to brace what the Fed's ready to throw at them.
So now over to you then, Imogen, because next week we don't just have the Fed, it's also the Bank of England. And I think I saw on my screen before walking over here for the recording that we had just about 30 basis points priced in for that meeting. Does that more or less balance the risks in your opinion? What are we looking for there?
I mean, it's probably okay. I mean, we are of the view, this is going to be a fairly important meeting. It's a monetary policy report meeting, so we'll get updated forecasts. It's the meeting where we expect bank rate to get back up to 1%, so back to kind of pre-pandemic levels. And also this 1% level in bank rate is where the Bank of England said that they would start to kind of think about quantitative tightening and active sales of their QE stock, which I'm sure we'll get to later. But anyway, so we think it's going to be a fairly important meeting, but I think a 25 basis point hike is pretty much nailed on at this point. I think the risks of a larger hike though, or no hike, are pretty minimal. That said, I think that the bank probably delivers this as a dovish hike. So having 30 basis points priced in, more than 25 basis point hike is probably slightly too much. But in terms of fading it for this meeting, I probably wouldn't be too aggressive. I think it's more about fading the kind of longer term picture where the market has a very aggressive rate hike profile baked in for the Bank of England. But yeah, I think this is delivered as a fairly dovish hike. The guidance back in the March meeting was that whilst they changed the language around how much further tightening would be needed over the coming months in the more dovish direction. Since then, we've heard from Governor Bailey twice, who's not only kind of reiterated that dovish twist in the guidance, but also recessionary risks. And he's been quite clear about how the Bank of England are kind of walking a very fine line between tightening against these very high inflation numbers, but also balancing the economy and not tipping that over into a kind of slower growth environment. So we've definitely heard much more cautious tones, I think, from Governor Bailey. And of course, that's been offset by Catherine Mann, for example, who we heard from on the more hawkish end of the spectrum last week. And markets were very quick to pay much more attention, I think, to the hawkish comments rather than the dovish comments from Bailey. And maybe that was because Bailey made his comments after market hours, whereas Mann's were in the day. But it does feel like markets are wanting to listen to the hawkish rhetoric and not really take on board so much the dovish rhetoric. So I think that next week's meeting could come as a bit of a dovish surprise, that even though we do get that hike delivered, the guidance around the further hikes is probably reduced even further. We also have the updated forecast round, and with the bank rate pricing where it is in markets, that obviously also reduces inflation over the kind of 2 or 3 year horizon within the Bank of England's forecast. So we expect that to come off both over the 2 and 3 year horizon in their forecasts. And we expect the vote too could be dovish, and that we could get Cunliffe and Tenrero voting in favour of a dovish descent rather than for a hike this time around. So yeah, definitely think that they're hiking, but with risks that is delivered on a more dovish rhetoric, I think.
I suppose it's important to say that even compared to just last week, in support of everything that you're saying about a slightly more tilt dovish in terms of the risks there, we have certainly had a round of more growth bearish global sort of news between what's happening in China and some escalations in by Russia and in the Russia-Ukraine war. So those are things that we're all looking very carefully at, not just relevant for the UK, of course, but particularly supporting what you're saying there. Maybe before we go on, you could just remind everybody what your call for subsequent meetings are.
Yes, sorry, I should have mentioned that. So we have, like I say, 25 basis points next week in the May meeting, and then we see an additional 25 basis points in August, which is the next kind of MPR meeting. And then we expect the Bank of England will pause from there into the end of the year. I think, we see risks that given the kind of inflation outlook that they will have to resume a tightening profile or a tightening process next year. So perhaps we could see an additional 2 hikes, let's say, in 2023. That's our risk case that's probably increasingly becoming our base case really now at NatWest Markets. But yeah, we definitely think only a further 2 more hikes this year and then a pause. So quite a lot more dovish really than the market pricing, which, as you say, has shifted a little bit over the last couple of days, given these kind of increasing global growth uncertainties, but we still think there's further to go. For context, the market has pretty much 25 basis points fully priced at every meeting between now and the end of the year.
Okay, right. So switching a little bit to a kind of longer end focus, but still with the Bank of England in mind. You've just been charging around talking to clients and getting the pulse on what people are thinking about quantitative tightening and gilt asset asset sales. So perhaps you can just sketch that out for us.
Yeah, I think we're going to have to count how many times on this podcast we say asset purchases instead of asset sales over the next 6 months. Yeah, I think we've even spoken about this over the last couple of weeks on this podcast, that I think a combination of the FOMC minutes a couple of weeks ago and the fact that it's pretty much market consensus that the Fed will start QT or announce QT next week, plus the fact that the Bank of England, we think, and again is market consensus, will get the bank rate to 1% next week, which is the level of bank rate which they said they would begin the process of quantitative tightening, has really focused investors' minds on what that means for the UK. It's our base case that actually they're not really in a huge amount of urgency to begin QT. So I think really what happens next week is that they just announce, pretty much as they say, in the minutes already, that they are beginning the process. But what that really means is the behind the scenes work in terms of setting up the working groups, probably consultations with investors, kind of feeling out market expectations and what would work, rather than any concrete announcement next week of kind of any imminent sales. There's been no guidance so far really from any MPC members to suggest that they're already kind of talking or thinking about this. There's a couple of reasons why I just think they're not necessarily in a hurry to do so, particularly given while they're becoming more cautious, I would say, on the likelihood of further tightening around rate hikes. It seems unlikely that they would then want to embark on tightening through a different channel, particularly as we get closer to summer months. I don't see why they would look to announce or begin quantitative tightening during low liquidity, which can sometimes lead to high volatility during the summer months. And also, yes, there will be a bank rate of 1% by next week, most likely. But when they kind of laid down this language around that they would begin the process of QT when bank rate was at 1%, it seemed like it was a fairly arbitrary level that they'd chosen anyway, but it was certainly a level that at the time they didn't expect to have reached so soon. So nothing about the kind of macro backdrop suggests to me that at the moment they're in a rush to begin active sales. And so I think next week we just get a kind of vague announcement that it's something they're thinking about. They have to address it because bank rate will be at 1%, but I don't think we get any kind of explicit details. Nonetheless, we do expect that they could begin as soon as next year, 2023. I think there are risks that they bring that maybe a little bit earlier. We might be thinking about November, say, but 2023 seems a reasonable base case right now, given everything I said before. And I don't expect them to do this on a particularly rapid path, I don't think. I think I've mentioned on this pod before, but we're really thinking about active sales of about 50 billion. And that would, coupled with the natural runoff of the portfolio, that would imply that they could halve the kind of stock of gilts on their balance sheet by the end of 2026, which seems a reasonable pace of tightening, I think, in terms of active sales.
Right. And so just to be clear, 50 billion per year.
Sorry. Yeah.
In case
50 billion a year.
We're talking about 50 billion a month.
No, sorry, 50 billion a year, which roughly, that works out to about 4 billion a month. But I think that, rather than announcing it like they did with QE during the pandemic, that they announce a big envelope, I don't think it will be that kind of a shock announcement. I think they will approach this quite flexibly. Perhaps even meeting to meeting, they might announce the kind of target that they would look to sell over that 6-ish week period, in fact. And again, they'll be flexible with regards to kind of market conditions at the time, but also the natural runoff of the portfolio, which, naturally is fairly lumpy. So it averages out to, say 50 billion a year or 4 billion a month, but in reality I expect a bit more of a lumpy profile than that.
And just to be clear, I mean, it does seem like it's quite early days, just in the sense that the consensus around this seems to, just the starting point for quantitative tightening, seems to be very, very wide at the moment. So that clearly needs to be shrunk a little bit. But anyway,
and it's so wide because. Sorry, I was just going to say it's so wide because we've had no guidance from the Bank of England on that. They really have mentioned nothing about this, and apart from the fact that they said that they would begin the process at 1%. So there's been nothing to steer market expectations in one direction or the other.
And how does this all leave you feeling about longer term UK rates then? I mean, you're bullish at the front end, given what you've just been saying about the Bank of England, but longer term rates have been more bearish. How are you left with after everything that we've talked about?
Yeah, still bearish longer term. We still have this 2% target in 10-year gilts, which was reached, well, very briefly last week, I think. I can't remember if we reached it by the time we recorded the pod or not. We briefly closed above 2% one day last week, but have pretty rapidly come back below that, as you said, Giles, with these kind of global growth concerns, with risks around China, escalation in Ukraine, etc. So I think that there's still further upward pressure in gilt yields. I don't think that this impact of quantitative tightening has been fully priced in yet. I think that there's still a kind of broad range of views about how fast and when, but markets haven't fully digested what it really means in terms of the additional duration that market participants will have to take down that isn't being taken down by the Bank of England anymore. And that, coupled with higher inflation and other things that we've talked about before on this podcast, plus the fact that from a foreign investor's perspective, gilt yields aren't attractive. I think that there is still some moderate upward pressure in yields, but like I say, we have this 2% target, so it's not as though we're talking about the kind of market moves that we've been used to of the last couple of weeks. So with that, why don't we move over to Europe, and I can pitch an almost identical question to you on the European side, because we have had a really increased amount of uncertainty, I would say, even just since we recorded the podcast last week. And fixed income has definitely reacted to that. You were also very close to that 1% target in bonds, and we've now rallied back away from that. How are you thinking about your views on duration in Europe here?
Well, no, I mean, I still think that we get there this year, and I still think that from where we are now, we probably end up this year rather higher than 1% in 10-year bonds, to be honest with you. So the bias is very much intact, but just in the short term, I would describe my conviction level as low. Certainly the lowest it's been in many, many months. I think that the growth concerns emerging from the places that we know about, there's an inflationary side to that, but there's also more of a disinflationary side to that, particularly potentially through commodities, especially if Chinese demand is likely to be weaker. It's interesting to see just how the market has been reacting. For example, with energy prices firmer on the back of the developments in with Russia and gas, this demand, this cutting off of Bulgaria and Poland, and markets getting a little bit concerned about what the consequences of that could be. That hasn't really followed through into break-even inflation, for example. So clearly, the market is also aligned to this greater ambiguity about what the implication is here for inflation. So whereas before we were very clearly sort of talking about stagflation, in the sense of much weaker growth and higher inflation, now these additional growth concerns, I think, do taper a little bit some of the inflation expectations as well. So that doesn't mean that we are turning around our certainly my call on rates, but just for the time being, there's a lot more uncertainty. Just a couple of other sort of small points. I mean, the ECB has actually been buying more recently, not less. And that's with a backdrop of actually across all issuer types, we've actually had reasonably light supply in April in euros. So you can see that the ECB has been trying to lean against the wind, and while there'll be payback from that at some point, I think that we can't really know when that's going to come. Again, they could very easily continue to lean against the wind in this way, and then in the really short term, we've got things like month end and so on as well. So, yeah, ask me again next week.
I think I ask you every week anyway, so don't worry, I will. So you mentioned inflation expectations. I guess the end of this week will be, we get some key data out of Europe, and that we get inflation for the month, and also we should get this week the ECB's economic bulletin as well. These will likely be out before, or perhaps already out before anyone listens to this pod. But what are we expecting from either of those things? Are they going to be important? Is it going to be important? I guess particularly because, as we discussed on the pod last week, there seems to be the hawks kind of taking, or had been taking over for the last couple of weeks on the governing council, and kind of winning the public debate, if you like. How much could these things matter for that?
I think a lot. I mean, what we're really looking for from both of those, the inflation data particularly, but also the economic bulletin, is a new anchor and a new impetus for ECB communication. I mean, it's been really it's been really quite cacophonous. I mean, and there's real, you're not quite sure who you're supposed to be listening to. those who normally lead the debate haven't really been expressing a particularly strong view. We know that the ECB has been trying to reclaim optionality, but I guess the consequence of the effort to get optionality back into monetary policy is that the guidance has to be weakened, and the markets are left to their own devices to sort of overshoot in potentially both directions. And so I think that is at the root as well of the very high volatility that we continue to see in the euro area. So yeah, I mean, we're looking for a little bit of new direction to central bank communication from that.
Just to wrap up the discussion on Europe, then, it feels like ages ago, I think, because there's been so much going on this week, but we did, of course, have the second round of the French elections on Sunday. As expected, this was a win for Macron. How are you thinking about French political risks then from here?
Well, I mean, the first thing to say, I suppose, is actually about French debt risks, where actually, I think that if anything, French bonds actually probably look a little bit expensive. But just that aside, the sort of bigger risks. Well, we very swiftly moved on to the twin questions of who will be the next prime minister, how will that set France up into the legislative elections in June. What is the prospect of a parliament that might be dominated by some other non-centrist parties, possibly the left? I think that those are all, we'll have to monitor week by week, but I think that those are all relatively small probabilities, I think, in all likelihood, but nonetheless, they are still things which are potentially market relevant. So I'll just leave that at that.
What about one final question from me then, to kind of wrap up the ECB and the French election discussion together, because we have had this a couple of times over the last week. I can see by your face, you know what's coming. How much weight do you give to this idea that Lagarde might give up her role at the ECB for a French political role?
Okay, I actually didn't know what was coming.
Oh.
The expression on my face was one of, oh my God.
How many other ways can you link French politics in the ECB?
No, you're quite right. But the fact that I didn't make that link probably betrays the reality that I don't think it's very very high likelihood. No, I mean, listen, every time I read anything about the names that might be sort of front runners for the next prime minister, Lagarde is always mentioned. But I think that's just because there was a story way back, I think it was February, that it first emerged, because essentially I think the story was that Nicolas Sarkozy, of all people, suggested her as maybe a good name. I don't think that there's all that much in it, and I can't really see why this would be a great move for her at this point. I mean, why would you take the prime minister's job unless you're very, very confident that you're going to end up being the prime minister of a nice, solid coalition that's on your side after the elections, where on the other hand you've got another 6 years as ECB president. But more than that, I don't think she ticks the box particularly for Macron either. I mean, yes, she is a woman, and I think that is probably a fairly important box to check up. And I do think that it's quite likely that the prime minister in France will be a woman. But I think it would be convenient if she were sort of more left-leaning, and probably also if she had more direct green credentials. And I'm not questioning Madame Lagarde's green credentials and her agenda at the ECB, but I don't think that is really what the political situation demands at the moment.
Yeah, okay, that makes sense. Well, I'm sure it's something we will get asked on again over the coming weeks and months. Anyway, probably all we have time for today. We'll catch up next week after we've had the Fed and the Bank of England, so we'll have a little bit more clarity on quantitative tightening on both fronts, I hope, and put some of this speculation maybe to bed. But yeah, have a good week. Thanks for joining me. And for all of our listeners, just a reminder that if they like today's episode, don't forget to hit the like button and subscribe so you can get the latest episodes as soon as they're available. Thanks.